In a surprising twist, American Bitcoin investors have suffered staggering losses amounting to $500 million, largely due to the actions of a mining company associated with Eric Trump. This shocking revelation has sent ripples through the cryptocurrency market, and here's what we know. On May 2nd, 2026, Forbes reported significant losses for American Bitcoin investors, totaling approximately $500 million. This revelation centers around the mining company, American Bitcoin, which is linked to Eric Trump. According to Forbes, this company claimed to mine Bitcoin at a price of $57,000 to $58,000 per coin, even though the market price was nearly half that. The timeline reveals that American Bitcoin has pledged to mine 3,090 BTC, but has only managed to mine 1,800 BTC so far. This discrepancy raises questions about the sustainability of their operations. The shocking detail lies in the fact that about 70% of their cryptocurrency was not mined, but acquired through selling shares and purchasing coins on the market. This practice is particularly alarming in a landscape where investor confidence is crucial. The cryptocurrency market has long been characterized by volatility and speculative investment. In recent years, regulatory scrutiny has intensified, leading to heightened expectations for transparency and ethical practices among mining companies. American Bitcoin's situation is reminiscent of past scandals that have rocked the industry, where companies faced severe backlash for misleading claims and operational mismanagement. The lack of transparency in American Bitcoin's operations could serve as a cautionary tale, potentially deterring future investments in the sector. The implications of this situation are far-reaching, especially when compared to previous events in the cryptocurrency space, where mining companies have either thrived or collapsed based on transparency and operational integrity. Unlike typical market fluctuations, this incident involves direct corporate misconduct that could fundamentally alter investor trust in cryptocurrency mining operations. The fallout from these revelations may lead to stricter regulations and increased oversight as authorities seek to protect investors from potential fraud and misrepresentation. Looking forward, the cryptocurrency market must reckon with the consequences of this scandal. Investors are likely to demand greater accountability from mining operations, and companies may need to adopt more robust reporting practices to restore trust. As the industry evolves, American Bitcoin's missteps could catalyze a shift toward more responsible investment practices, ultimately shaping a more transparent and sustainable future for cryptocurrency mining. The next few months will be critical in determining how the market adapts to these challenges. A recent report detailing a staggering $500 million in losses within the cryptocurrency market has sent shockwaves through the financial community. This significant financial setback is not merely a statistic. It represents a profound erosion of trust among investors, particularly retail investors who have increasingly flocked to Bitcoin and other cryptocurrencies, enticed by the promise of high returns. The immediate fallout has been a noticeable decline in Bitcoin's market price, which has fallen as skepticism mounts regarding the sustainability and ethical practices of mining companies. Historically, the cryptocurrency market has been characterized by its volatility, but this incident emphasizes the critical need for robust regulatory oversight. Mining operations, often operating in a gray area of financial regulation, have come under scrutiny for their environmental impact and business practices. Many mining companies have faced criticism for their excessive energy consumption, contributing to climate change concerns. As the cryptocurrency market continues to expand, the environmental implications of mining operations are drawing increasing attention from both the public and policymakers. With the increasing adoption of cryptocurrencies, regulators are facing mounting pressure to implement frameworks that protect investors and ensure transparency. The economic implications of this loss could be far-reaching. Investors, wary of potential future losses, may reconsider their positions in the cryptocurrency market, opting to withdraw funds or avoid investments altogether. This pullback could stifle innovation and growth in a sector that has been rapidly evolving. Politically, the incident could serve as a catalyst for lawmakers to initiate discussions on the necessity of imposing stricter regulations within the crypto industry. Furthermore, this situation serves as a stark reminder of the inherent risks associated with investing in cryptocurrencies. Many retail investors, often lacking the resources to conduct thorough due diligence, may find themselves disproportionately affected by such downturns. The average person should take heed of this story, as it underscores the importance of transparency and accountability in corporate practices within the cryptocurrency space. Looking ahead, the cryptocurrency market may face increased scrutiny and potential regulatory changes that could reshape its landscape. Investors will need to remain vigilant, informed, and adaptable as they navigate this rapidly changing environment. The future of cryptocurrency will depend not only on technological advancements, but also on the regulatory frameworks that will govern its growth, sustainability, and ethical standards. The backdrop to today's revelation involves a series of events that have unfolded over the past few months. American Bitcoin, linked to Eric Trump, has been under scrutiny for its operational transparency. In the weeks leading up to this news, there were growing concerns among investors regarding the company's claims about its mining capabilities and the sustainability of its business model. Many industry experts have pointed to a lack of clarity in American Bitcoin's financial practices, raising alarms about its long-term viability. Previous incidents in the cryptocurrency space have shown that when companies fail to deliver on their promises, it can lead to significant market downturns and loss of investor trust. The rise and fall of notable firms like BitConnect serve as cautionary tales that highlight the risks inherent in this volatile market. In this case, the failure to mine the pledged amount of Bitcoin and the reliance on share sales to acquire currency has drawn parallels to other mining operations that have faced similar accusations. Such practices often stem from a desire for rapid profit, but they can result in devastating consequences for investors who trust these companies based on misleading information. The motivations behind these actions reflect a broader trend of corporate misconduct in the cryptocurrency sector, further eroding public confidence. As the dust settles, the impact on American Bitcoin's reputation could be profound, with potential regulatory scrutiny looming. Investors are likely to demand greater accountability and transparency from cryptocurrency firms moving forward. In light of these developments, stakeholders are urged to exercise caution. The future of American Bitcoin hinges on its ability to restore trust and demonstrate genuine operational integrity. If it can navigate this crisis effectively, it may yet emerge stronger, but the path forward will require significant changes in both strategy and communication. The fallout from today's revelations regarding the cryptocurrency mining sector could lead to several significant outcomes. First, we anticipate a robust regulatory response from financial authorities in the United States. This response aims to ensure greater transparency and accountability within the burgeoning yet controversial cryptocurrency mining industry. Regulatory bodies like the Securities and Exchange Commission have been increasingly vocal about the need for oversight, particularly following the rise of companies such as American Bitcoin. These companies have raised alarms about potential market manipulation and lack of consumer protection, prompting calls for tighter regulations. Second, the cryptocurrency market may experience heightened volatility as investors react to these developments. Such volatility could trigger widespread sell-offs, resulting in further price declines for Bitcoin and alternative cryptocurrencies. This reaction is not surprising, given the sector's history of sharp price swings in response to regulatory news. In a broader context, this situation reflects growing concerns about the environmental impact of cryptocurrency mining, which has faced criticism for its high energy consumption. As public awareness of climate issues increases, investors may begin to favor more established and environmentally conscious companies or shift their focus to traditional investments. Industry experts predict that unless significant reforms are introduced, investor confidence in the cryptocurrency market could be severely undermined. The current scrutiny could lead to an exodus of investors seeking safer, more regulated avenues. In the coming days, it will be crucial to monitor any statements from regulators and major industry players. Their responses will likely shape the future of cryptocurrency mining and investment. The pressing question remains: Can trust be restored in a sector that has faced significant scrutiny and skepticism? The answer may lie in the industry's ability to implement meaningful reforms while still fostering innovation, setting the stage for a more sustainable future in cryptocurrency. As we consider the potential for regulatory changes and market volatility, what are your predictions for the future of cryptocurrency investing? Share your thoughts in the comments and subscribe for more daily deep dives.